would much rather be a buyer tomorrow than a seller today in this market. In terms of trying to call the bottom, I think that's a very hard thing to do. So a couple of things that we're watching right now. We actually maintain a bear market checklist, which is a series of 18 different criteria, which is trying to tell us, right now it actually tells us to buy the dips. But a lot of that information is based on the strong consumer. It's based on leverage. It's based on debt service ratios that are actually relatively healthy. We also have a panic euphoria model that we look at, and we haven't quite reached that panic territory yet. Once we see that panicked sell-off, then that would be a very clear signal to get into the markets.
Is it possible to just be a purely analytical economics business type person here and say I'm looking at the effects on the economy and what it brings, or don't you have to take into account just the fear of and this being human and the idea of a pandemic?
I mean, it would be amazing if we could say this is all fundamental and economics based, and you see some of that in terms of people looking at earnings growth and revising earnings estimates down. We did that in terms of looking at zero earnings growth or potentially negative for this year, global growth as well. But when you're looking at panic headline risk, and it's not just about coronavirus. We have the elections coming up. We have Super Tuesday coming up that could introduce even more volatility into the market. So I think it's really a combination of those things. And you add on, I know you guys were talking about this a little bit earlier, a lot of the selling that we're seeing, it's actually not from our investors. I don't have a lot of investors out there that are panicked. It's more the machines and the programmatic trading, and you can see that in a lot of the gap downs that we're seeing in the market. It's not individuals like us or kind of long investors that are saying, I need to get out.
Right.